which has been meeting since yesterday to decide on interest rates. Some data they'll be considering are yesterday's consumer inflation numbers, today's producer inflation release. Joining me to preview what that decision is likely to be is Sizwe Nxedlana. He's economist at FNB Commercial. Sizwe, good afternoon. Thanks for coming in.
Good afternoon.
Sizwe, consumer inflation back within that target band of 3 to 6%. We had producer inflation figures slightly better than expected today at 3.5% for last month. What's your view? Will the MPC cut rates?
No, we would be of the opinion that it's unlikely that the MPC would cut rates. Remember, the decision last time was predicated on the fact that the Reserve Bank said it wasn't a 100% consensus decision, and I think the reason why it wasn't a 100% consensus decision to leave rates flat was due to the fact that the economy by then had not been showing signs, particularly domestic demand had not been showing signs of recovering. What we are seeing now is an inflation trajectory that's downward, but an economy that's beginning to show some signs of recovery, which we think should start to reflect in better retail and wholesale and motor trade figures. So on the back of that, we don't think that the MPC is going to want to cut rates. Over and above that is the fact that maybe the second round impact of these public sector charges, remember it's not just electricity, it's also petrol levies, it's also general utility charging, that poses some risk going forward for the inflation trajectory. So our opinion at the moment would be, and we've held this for some time, in fact, is that rates remain flat for most of this year and start possibly increasing in the first half of 2011.
Of course, we have had two developments since the last MPC. One of those is that Eskom has been granted a 25% tariff hike for the next 3 years, and that was one of the unknowns at the last MPC. They didn't know, although they had been factoring in 25%, they didn't know if there was going to be a 35% hike. And of course, we also had at the budget, Pravin Gordhan, the finance minister, coming out clearly saying that the mandate of the Reserve Bank explicitly included growth. Don't you think those two developments could help bend the MPC's arm today?
No, I mean, if you look at these, the electricity tariff outcome, the Reserve Bank was forecasting inflation to remain between around 5.5% and 6% over the medium term. That was the last forecast, which was factoring in a 25% electricity tariff. Subsequently, as I've said already, we have started to see the economy begin to show some signs of recovery. So from a growth perspective, for a flexible inflation targeting central bank, with the economy definitely, and even some of our internal indicators in the bank are starting to show that activity, particularly in domestic demand, is starting to improve. We think that the window to cut rates from a growth perspective was perhaps in the last two meetings. That didn't happen, so we think maybe they just missed that cutting cycle, and I think 7% over the next 12 to 18 months is what's most likely to happen.
And of course, we know the inflation target's not 6%, so the fact that we've broken below 6% isn't all that good, because the inflation target's 3 to 6%, yeah. So we should actually be aiming for the middle range of that, which is 4.5%, and we're quite away from that.
Yes. So, I mean, if you look at what's happening in inflation at the moment, we're sitting at 5.7%. If you look at us relative to our trading partners, we're still more than double in terms of consumer prices. And we know that what's driving this decline in inflation at the moment is disinflation, strong disinflationary momentum within the goods component of the CPI basket, which makes up about 55% of the basket. And if you look at what's going on, it's food inflation, which is sitting at about 1%. It is things like clothing, which is sitting at about 3%, household contents, and so on. If you then look at the other side of the basket, which is services inflation, things like household services and so on and so forth, and administered prices in particular, which include electricity and utility prices, that whole services basket is sitting at about 6.8%, well above the SARB's mandate. And we still know that that services component and that administered component of the inflation basket is where the pressure is going to be coming on in the future. What we think is that this services component is preventing a more noticeable, a more concerted decline in inflation towards the 4.5% to 5% range. And that's why we have a forecast of, because of these inflationary pressures from the services component that are going to come through, we've built in that fat, and we're sitting with an inflation forecast of 5.5%, which if you think about it, if there's any upside risk, we think that if there's any risk, the risk is going to be to the upside, and that's why we again reiterate that it's unlikely for the SARB to want to cut rates going forward.
But now if it's services rather than goods inflation that is the risk going forward, interest rates really don't help, because putting up interest rates perhaps in a year's time isn't going to stop administered prices going up. So it's something that the consumers can't control. It's something we're not going to cut back on. So it's really a blunt tool, and interest rates.
Well, not necessarily. The forecast of interest rates being increased in the first half of next year would then be due to the fact that that's when we start seeing goods price inflation bottom and begin in its upward trend. If for example, you're looking at food price inflation, at the moment we know that soft commodity prices are very low, which explains why we're seeing such weak food price inflation. But our agri guys tell us that maize prices, for example, are bottoming. They're sitting at about $1,000 a ton. They were about $2,500 18 months ago. Those soft commodity prices are going to start increasing. Those base commodity prices are going to start increasing. That's going to start feeding into the input and cost structures of the economy, which is why we see inflation bottoming over the next 18 months and beginning another upward trend, which is why for a Reserve Bank that's looking 18 to 24 months ahead, we think that goods inflation starts to pick up towards the end of this year and into the first half of next year, coupled with services component, which is very sticky on a downward trend.
So how soon will the Reserve Bank have to start increasing interest rates if it is looking 18 months ahead?
No, well, if you're sitting 18 months ahead, when inflation starts to increase, when inflationary pressures, particularly from a goods inflation perspective, start to come through in the first half of next year, as we expect, then we think that interest rates would have to start being increased during the first half of 2011. But what's happening at the moment is very good for the economy, because if rates do stay flat for most of 2010, that would be the longest period which we've had unchanging interest rates, I think, since inflation targeting was started.
So even if there is no cut today, it's still not bad news?
No, I definitely think it's very good for the domestic economy for us to have stable interest rates.